It feels different. Es que es distinto. No importa si estás en Saturno o en la Tierra. Al final se necesita una buena charla con un amigo, especialmente if he happens to be an expert. Quien la apueste, at the end, it's all you can debt.
Hey everyone, welcome back to All You Can Debt Season 2. Super excited to talk with Thomas today from barkr, aka the Barkr Price, aka barkr with no E.
Sorry, 1 second. Isn't it episode 2, not season 2?
It's
Well,
season,
it's season
2,
two.
episode 2.
Yeah, but we're not sure if we're releasing yours as episode 2 yet, so
Oh, that's true. Maybe we should
Sorry,
release it as
but
number
maybe.
1.
TBD.
Maybe we could release it as number 1. Give us the goods and we'll release it as number 1.
Give me
Give me the goods.
And yeah, or it can be a separate season where it's just Thomas and Thomas, and then V is also here.
Yeah, I'm the guest.
But one of the things that we want to do this season is, we're talking about the U.S. market a lot. We're talking about everything interesting that's been happening in private credit, and Thomas is one of those people that is creating truly unique, interesting technology.
Tom, if not one of the most unique, most innovative things that has happened in the last decade.
That's very kind, Valentina.
It is also true.
You are very kind, and I believe that because that's why I'm doing it. But I'll just sort of give a little overview about what we're doing and the impact it plays on private credit and asset-backed lending, and why it supports what you just mentioned about how important it is. So basically, we play a pretty vital role within asset-backed lending, and when you take a step back and you look at that type of lending as a whole, there's really only two primary risks within asset-backed lending. One is the borrower and the other one is the asset. And there's a lot of tools, a lot of technology, there's a lot of applications and great progress has been made on how to accurately underwrite a borrower, right? Like how do you mitigate that risk? How do you do all of your research, your KYC, your AML? Like, how do you make sure that you're up to grade on underwriting the borrower? You can't really say the same for asset valuations. And that's kind of a big problem when you're literally doing loans against the asset. So to give you an example of what that looks like, historically speaking, you could ask 5 different people to value an asset, right? Whatever that asset is. It could be a private jet, it could be a piece of real estate, whatever the asset might be. And you end up with 5 different prices. And that's really not very confidence inspiring for a lender. It makes the lender's job much harder. And that assumes that the valuation firm can even price the asset at all, which often they can't in the case of something like a GPU, which...
Why do you think in the past we have been able to value the borrower and not the asset?
Yeah, so I think the real problem comes back to the fact that most valuations are they're sort of subjective, like it's opinion based, right? So it's someone's expertise or ability to gather data and then provide some kind of rough guidance or estimate on what that asset is worth. Whereas we take a much more technology based approach. So we're actually scraping huge volumes of data. We have almost 300 million data points that we're drawing on when we're pricing an asset. And the second big problem outside of accuracy is that most valuation firms, in fact, all valuation firms, they don't back up their valuation. So they'll say, hey, look, this is the price that we think, but this is our opinion and you can't sue me. And there's nothing, this is it. I'm giving you just a rough idea.
So scraping is not new, right? And especially if you think that you have a business of asset valuation, scraping is something that has existed. Why do you think so? Scraping has already been done in the past, and then the valuation has never been backed up, but it didn't in a regular world of just valuing in a startup or valuing a borrower, it's still not backed up, right? So that is just and we'll talk about that because I think that's one of the most innovative things in itself. But before barkr, why in the world couldn't assets be valued, not necessarily how you're doing it, but as an industry worldwide? Why wasn't it a practice?
I think people were doing it and do still do it, but I think one of the examples that jumps out to me, I was talking to a client about a year ago, and they used to run asset-backed lending for a large firm, specifically with private jets. And his example was really illuminating, and it speaks to why we exist. they would obviously have to price that portfolio of jets on a certain cadence, right? Like every quarter or on an annual basis in order to be able to do the reporting that they needed to do to their investors. They would call this guy who, like, charming old man, like 70s, whatever, would like come into the conference room bumbling along with like stacks of folders, sit down in the conference room, spread out all his folders on the conference table, and then go through the list that assets they had, list of private jets they had, and then just sit there for days on end and find reference transactions in his binders and then come up with some kind of valuation. And then they would have to pay him some exorbitant amount of money for 2 months of work. And they had no real faith in the values that he was giving them. Not that he was doing anything wrong. It's just that it's not really drawing on the vast data sets available. So that kind of really speaks to me in terms of why what we're doing is important.
So would you say that what changed is, of course, besides the backing it up with the insurance part, but before you had access to the data and you could scrap the data, but you couldn't make sense of that data at scale. That's where AI came in. Would that be like a good way to conclude it as to why it couldn't be priced before? It's like you had the data, or you had the ability to get the data, you weren't able to look through on the unstructured data to make the final decision.
Yeah, I think it's the technology is now at a place where we can use various different data sources in order to be able to predict a price. It's partly structuring the data, is partly also, importantly, the data that's available, right? We're able to pull together pretty much all publicly available data, but then we also require the underlying private data that our clients are using to do the loan, right? So if a lender's lending against a private jet or a piece of real estate or a GPU, they have to share all the same asset details they use to do the loan with us. And historically speaking, that hasn't been the case with valuation firms. Often they did not have access to anywhere near as much data and information that we require. And the reason why we're able to do that is, as you pointed out earlier, so we issue a valuation and we wrap it in a contractual guarantee. And that has a material benefit to the lender, right? The lender can now say, okay, well, I believe in the price is accurate, and you're backing up the price with insurance that's backed by like AAA rated insurers. So now the lender can expand their profit margin, and they can do it in different ways. They can lower their cost of capital. They can, if it's a bank, lower their loss given default or the risk rating. There's a bunch of different ways that they can recognize some capital relief from the risk transfer. So that puts us in a position where we're saying, hey, look, we're helping you make more money. So you kind of have to share all the same data with us that you're using to do the loan in order for us to price it accurately and help you. So that is another reason why there's a material benefit to our product. Like, one is like we're gathering significantly more data than prior valuation firms were able to do. And then the second reason, as I mentioned, is that guarantee component that backs up that price. So it just puts us in a different league from a regular valuation.
I was going to ask a quick question. I might have missed this. Like, specifically, like with the models that you're using, are they like native to like you built them, or are you using like open source models? And then thinking about, you have access to information. Is that something that like private information, is that something that lenders kind of ask you about? How do you kind of like deal with that information security concern?
Yeah, so we use an open source version of Gemma, basically, that we retrained on a number of different valuation and appraisal based content and transactions. Effectively, what we're doing is our AI is treating the valuation of assets as a mathematical reasoning problem rather than a language reasoning problem. That's what we've trained it to do. And so it is our own proprietary model that's doing this.
First of all, let me explain to the audience that is listening to us why I think what you're doing is one of the most innovative things that actually I kind of want to know why you came up with this idea. So let's start there. And then within that story, you tell what the innovation is. Because like, let me just put it in context. Today, as I was coming into the podcast, or I was like trying to prep for it, I thought about it and I said, without calling it a CDO, it looks like a CDO for an asset. So So can you explain to the audience, first of all, like, how did you come up with this idea? Why is it so simple and so beautiful? And what do you think are the effects that it has perhaps on whether asset liability management or Basel requirements or anything associated with risk management, regardless if you're selling it or actually, no, maybe differentiate it from a banking perspective, which is regulated versus the non-regulated world.
Yeah.
But how did you come up with this? Like, I'm not sure if I
No,
ever
it's
asked
a
you
good
that
question. So, my entire career, like I started out in insurance, like high net worth insurance, and then I moved into like being CEO of a couple of different marketplaces and luxury asset focused companies, like that kind of thing. And through that time, I encountered this problem at every turn. No one really knew or could definitively say what the value of an asset was. And I always found that kind of curious. And I thought it was specific to the luxury market. I thought, okay, well, fine. I'm sure other markets, it's much easier to price assets. And we kind of realized pretty early on that that's just not the case. Types of hard assets that are used as loan collateral, like most tangible assets, no one really knows what they're worth until the point of sale, right? Like that's when the market really speaks and tells you what an asset is actually worth. But historically speaking, each one of those tangible assets, each one of those hard assets would have valuations with huge swings. And it just didn't make any sense to me. Same with my co-founder, Madeline. Like, it's a known problem, but we were both like, surely there's a better way. Surely there's a way to actually address this because no one's done it yet, but maybe they haven't done it because no one's
When did you start?
doing it.
When did you start thinking about this?
This
what year was this?
2020, 2021, around there. And then we formed the company in September 2022. It was something that we were bouncing around like the idea of for a while, but I was at least, and then brought Madeline in. And then, yeah, so I mean, that's fundamentally the problem is like pricing the asset, right? And developing the technology to improve the pricing accuracy. And then in terms of your reference or the understandable comparison to like a CBO or like my kids like Labubus. Yeah, sorry. I'm like, let's do collateralized Labubu obligations. Like, if we could do that, then I'm like, okay, we could price anything. So in terms of that, you're not like you're onto something. Like that's also how the product kept evolving, right? Like we're not an insurance product and we're not trying to be an insurance product, but we are insurance adjacent. And what we're trying to do is say, okay, well, I know Apollo has also been voicing this recently as well in a different guise. Like, what if we can provide a real mark-to-market value on an ongoing basis for all tangible assets? And what impact does that have on the entire asset-backed lending space? And how much more comfortable do lenders become, right? How much more lending can they do? And how much does that expand the entire sector? And those are key questions that don't get answered without a product like this. And you can wrap it in a CDO, you can wrap it in a residual value insurance, but whatever the wrapper is, it all comes back to pricing. How do you price that asset? Once you know how to price the asset, then you can start delivering all these different products in different ways, which is why we're now like we have multiple insurance companies who want to use our product to develop their own insurance solution, but they're using our pricing tool to be able to do so.
It's very interesting. And I wonder, how do you actually keep off the insurance lane and you actually just like, it's a feature, but it's not the product in itself and the product is the pricing. How do you see that developing in the next couple of years? Because like what made the GFC is the ability to insure whatever you wanted in however packaged methods they were created, right? Where do you see that you potentially have to make a decision on, okay, I definitely don't want to be the insurer, or I don't want to be the focus to be the insurance product, but I want the focus to be on the pricing, that it has a feature just called pricing. How do you see that evolving over time? And especially with the question that I asked you previously, which is, how does this affect the pricing of the regulated and non-regulated entities that they have on their own on their balance sheet,
Yes.
right? Like if I'm a bank and I can use Thomas's product, well, am I really using the product because like Thomas is really giving me like correct, accurate pricing it? Or am I doing it because in reality, I have my risk management person behind me saying, hey, if you don't come with insurance, this is nowhere near AA rated or AAA rated, right? Does that make sense? What I'm trying to get to?
It does. Look, I think at our core, we are a pricing tool, right? Like we're able to price assets accurately. But then how do you package that? What does it look like? And how do we work with other partners? And what benefit do our clients and the broader lender world get from using our product? They wouldn't be able to reduce their cost of capital if they weren't able to recognize the risk transfer. And to recognize the risk transfer, you have to have some form of either rating or regulatory application or those types of things. Regulatory applications are much harder and the scrutiny obviously is much higher. And Basel III especially, it has specific treatments and discounts for insurance. We fall into a particular bucket where the lane that we're playing in is more, it's like a guarantee. And we actually in the process right now, we rate our company that issues the guarantee. And that allows our clients to recognize the A rating of the underlying guarantor. But that's also not sufficient for everybody, right?
Meaning, like, to recognize your insurance as it follows through, like if the insurance is whoever, you're going to get that rating from
So
that
we're
insurance.
creating our own insurer, and we're going to get that insurer rated. And then that insurer's only responsibility is to back up our guarantee. So once that's in place, then it addresses a lot of the hurdles with some of the banking regulatory requirements, but it doesn't address all of them. And I'm also okay with that. We may continue to evolve the product. We might issue the product as a swap, but we're also going to continue working with other insurance companies who want to base their product on our tool. I'm not trying to own the entire sector necessarily, because I think we end up being a bottleneck to success. And that's something that we realized like relatively recently as a group, that it probably makes more sense to encourage and support similar products rather than necessarily trying to funnel all risk through us within this sector. And I think we'll probably end up benefiting because of that, because there's multiple reasons why different companies might want different products to solve different problems. And if we're behind all of them, then I'm fine with that.
GPUs is probably one of the most fun conversations that we're going to have. But you mentioned residential. If residential has been an asset that has been valued by the industry,
Yes.
probably since the 80s at a scalable way.
Yes.
Actually, I'm not sure which decade, but it's been for a long time. Why do you think like that's an opportunity for you? What do you think it's missing?
Mostly because of the area that we're focused on. We're not trying to get involved in mortgages necessarily. You're completely right. There's a lot of solutions available for the broader mortgage market within residential. We are more focused on solving a specific problem our clients have. And our clients, a number of them operate within the home equity line of credit or HELOC type universe. And there are no solutions for the HELOC-focused investors. So we actually see like a pretty good opportunity to kind of widen our funnel a little bit with existing clients who are already doing these types of loans, and they need a solution like ours.
Super interesting. Go ahead, Tom.
Yeah, I was going to ask, because there's a lot of like fintechs out there that are giving these loans, whether it's home equity. There's a bunch of different ones. There's HELOCs, there's home equity. There's a few different products. So how do you work specifically with those, like say like fintechs that are giving those loans, and then I guess like the lenders who are
I haven't launched yet, but the first way we do it is that they are all approaching us without us even looking for it, because I guess people are talking about what we do, which is great. And then a lot of people, as we talked about at the beginning of the call, a lot of people have this problem and there hasn't been a solution. So they come to us and explain what's going on. And then we've been talking to their capital providers and the fintechs themselves about, okay, help me define the problem. Tell us like more about what it is that you're looking for a solution for.
I think there's been a lot of discussions, whether we're in the AI bubble or whether we're not. And part of the discussions, I think, has been driven by the bubble recognizer of the '08, which was Michael Burry. So he put up this Substack where he said like the GPU's depreciation schedule, I disagree with them. I'm actually not entirely sure what specifically was his claim. You probably definitely know it more, but I know you disagree with him. Why do you think he's wrong?
He latched onto something which is at its core true, and I'll explain what that is, but then mischaracterized it or misunderstood why. Or maybe he didn't and he's just doing it for clicks. I don't know. The specific thing he's pointing to is an accounting trick, right? Like most of these hyperscalers, they're purchasing GPUs X price and they're writing them down. Initially, they were writing them down over the course of like 2 years, somewhere in that range. And then that changed and people started to say, okay, well, actually, like the hyperscalers were like, we're going to write them down over 5 years, 7 years. And the consequence of that from an accounting perspective actually impacts revenue. So you can actually recognize more revenue because your costs are lower. All things that people know a lot better than me. But so it can look like your revenue's juiced. And he was like, this is wrong. This is false. This is an accounting trick to make it look like things are better than they actually are. But these guys are spending hundreds of billions and they're making it, they're hiding it kind of thing. Now, the bit that's true is that, yes, like that's what happens if that's how you recognize your costs. That's what happens to your revenue. So that bit is 100% true. But the bit that's not true is he then went on to say that they were like misleading, that this is false, GPUs don't last that long. And these companies, these hyperscalers were doing it on purpose and none of it's true. Like this is a bubble. That bit's wrong. The reality is that GPUs have a much longer life cycle than Michael Burry or anyone else within that sort of naysayer space, I think, understands or expects. We're in a position where we're taking on risk, right? Like we're pricing assets and we're promising that price. So we better be good at what we do. And I can tell you from all the information and data that we have, those GPUs and those data centers, they have longer life cycles than 18 months, longer than 3 years. They're closer to 5 to 7 years. There may be an initial drop, an initial depreciation. That is true. But the tail on these things, the residual value over time is really quite long. One of the things that I'd like to point to as an example of that is if anyone can point me to an example of a data center that got shut down or GPUs that were ripped out and are no longer online. And I have yet to have anyone offer me an example of either of those two things. There's definitely cases where GPUs may have been swapped out and then put into a different data center, but they were not thrown in the trash. They're still functioning. They're still revenue producing. So that gives you your floor price, right? Like you can start to calculate, okay, like how much are these assets being bought and sold for on the open market? And then you can start to determine their life cycle.
And then what about actually like the technology and like hardware itself, like needing to be updated or something like
Yes.
that?
I mean, we definitely look at the moment we look at just specifically the GPU, but you're right that the broader materials, which I think is referred to as BOM, which I always find hilarious, the broader the BOM and also the software that is running on that GPU has an impact. So we do look at those things as well. But with that said, all of that information is also available when a client is purchasing the asset. So the market is pricing in all of these things when it's making that purchase. So you can use all of this information to determine what the actual valuation of that asset is over time. But you're right that those variances do have an impact on value, as does location, right? Like a server in the US is going to have a materially different price than a server in, I don't know, Malaysia or something. So there are factors in there. But again, these are all things that you can discover. They're all things that you can account for.
You mentioned something that I'm not entirely sure about. You mentioned that the depreciation at the beginning is a little bit more, it's a little bit steeper.
Yes.
Is that because of the training required, or you typically use it for training when you first buy it and then that depreciates the machine? Or like why does it amortize faster? Or why does it depreciate faster?
It's a good question.
At the beginning?
There could be a number of different reasons. My general take is that, this is going to sound bad, but I think NVIDIA is pricing these things knowing full well that there's a premium on top of what they, like it's not costing them K to build these things, anything close. So there's a certain premium associated with that. Now, again, like if I had a GB300 in my pocket right now, A, my pocket would be huge, but B, like I would be able to resell that asset for more than I bought it for right now. That is 100% true. So that premium is, you could argue, justified. The second thing is you do have to account for how quickly NVIDIA or other companies are actually releasing new types, new versions, and that will have an impact on the prior version for sure. Usually what we see is the latest version is running the latest models, but then what happens is as a new version comes out and the latest models shift to the newer version, then the older versions, they don't go away. They actually see significant usage and interest from the non-hyperscalers. So if you step down a level to like SMEs, like small to medium-sized enterprise or whatever, people who are, whether it's an AI startup or like who just got funded with $100 million, because apparently every AI startup gets $100 million just for being an AI.
Is that why you changed I see your email changed to barkr.ai?
Oh, you got me, Tom.
Genius.
You got me. As soon as I did it, then I got a check in the mail for $100 million. Yeah, so then there's a waterfall of these GPUs going down to smaller, medium to small size enterprise businesses who are also looking for compute, but they just don't need the latest GPU to be able to satisfy their needs.
That is interesting. The value of the machine is still high because there's demand at the middle bottom of the food chain. What happens if that demand decreases over time because the new college chips platform, I know NVIDIA calls it a premium partly because it's way beyond chips. It's like the everything on top of it that you can do, the fine tuning or the training, etc. on it. So what happens is there a scenario where the supply of new chips basically covers the demand even for the bottom of the food chain, where those like the ones that were done like 5 years ago. I mean, we're so nascent into it,
Exactly. Yeah.
right? Like imagine if in like 3 years, I don't know, like I know there's a company called, do you know Cerebras? Maybe I'm spelling it wrong or saying it wrong. Cerebras, or there's like a company that it's like a 10th of the price and the compute is apparently even as good or even better. Let me look it up and we'll show up.
I think I know who you mean. They're relatively new chip maker, right?
They're actually, I have no freaking clue, but so let me see if I can share my screen. I
Just
would
to
need to.
answer that fundamental question, right? In terms of how we look at it, the volume of demand at the moment so massively outstrips supply that even if you doubled the number of data centers, you wouldn't meet the demand. And one of the things that we also think may happen is that there's just a fundamental rewriting of the math, right? Like which has happened before with like JPEGs and like through the life cycle of the internet. It's happened a couple times. Let's say you see a 50% improvement in supply, like you're still not meeting demand. It's just the demand is insatiable, and it's not like it's not like NFTs, right? Like where we on this call like 5 years ago or whatever, we'll be like, oh, this is the NFTs of the future. NFT as a technology is interesting and has applications, but it doesn't fundamentally change the way people do business. And that is actually what happens when you implement different solutions within, whether it's agents or whether it's LLMs or SLMs or whatever it is. You are at a very core level changing a business's ability to be efficient and ability to grow and really kind of expand in a way that would have taken many, many, many man hours before. And this is an aside, but just very quickly, and I think that's the bit that is most exciting about the age that we're entering. I don't know how much it's going to impact jobs. What I think it's probably going to impact more is people's productivity. And every time you look at stats around what workers do when they have access to AI, it's not like they stop working. They actually work harder. They're actually more productive. They actually output more. And I don't think we're prepared for what that means long term.
Yeah, so Tommy is showing it over there. So GPU, I'm not sure what or the GPU is maybe like the NVIDIA chips. We would need to double check. And then Cerebras, it's the tokens per second. I don't know how to interpret this. Someone showed this to me once, trying to tell me that Cerebras was so much better than NVIDIA in just the not the full platform, which I know is what Jensen talks about a lot of, but just like the chip, I have no freaking clue. So Tommy, let me ask you, let me rephrase it. So as long as the demand is exceedingly so much bigger than whatever supply is right now, you're not going to have this conversation of like the pricing of the GPU being significantly, or that you need to change the depreciation schedule. When do you think that breaks? You know what I mean? Like, are we like from that conversation, are we possibly like 3 years out? Are we 5 years out? Are we 10 years out? And depending on, or what do you think changes? And then how does that change or possibly change? How does that affect Barker specifically in your clients? How would that
Yeah,
work, for
so
instance?
I think at a sort of philosophical level, I don't think that's really going to fundamentally change in terms of the demand for compute until we're at a point where everybody has as much compute as they want, right? And for us to get there, I think at least, the world, like basically like a tiny fraction of the world, but is doing a pretty decent job, relatively decent job of satisfying hyperscaler demand, right? Hyperscalers are growing, like they're pulling compute from each other when they have excess compute. You probably just saw the xAI and Anthropic deal, right? Like xAI had surplus compute, so Anthropic has come in and purchased that surplus compute. So there's a lot of demand, but also a lot of supply being delivered to that hyperscaler. It's once you start looking at the level down, right, that we were talking about earlier, and then a level below that. So I think the next area of where there's huge demand and very little supply is within that small to medium sized enterprise sector, right? And so the level below, whether it's the AI startup or whether it's like the mom and pop CPA or whatever it is, who can run more efficiently. That I think that whole sector, I actually anticipate being significantly bigger long term than the hyperscaler sector. We've only just started to address that. And at the moment, we're addressing it kind of via the hyperscalers. Like a lot of them are using Anthropic, a lot of them are using like whatever. But I think what's probably going to happen is people start to realize that actually I want to use my own tool on my own machine, and I don't want to be sharing my information like I do, like the backlash with Google and others and Apple being everything's on your own machine. I think we're going to see a repeat of that show, and people are going to say, actually, I want all my private data on my own server. And then we're going to see probably very soon or around the same time, people who just want to run, consumers who want to run models on their own laptop, on their phone or whatever it might be. So when you look at it from that perspective and you think about how enormous that market or those two markets are, then I think we have a long way to go before we come close to meeting the compute demand within those three stacks.
So if the depreciation right now schedule looks like roughly about on average 5 to 7 years. So would you say that not before 2030, we're going to have a change within that like demand supply curve, significantly changing the pricing of at least the chips that you're
I would be
underwriting
very
today?
surprised if by 2030 people are ripping out GPUs from data centers. I mean, we're not even close to building the number of data centers that the demand needs, but a lot of them are getting shut down. Communities are pushing back, which I get. The power supply is insufficient, I should say, in order to be able to meet compute. It's as much a story about power as it is about the GPUs. So there's multiple constraints that I would argue put us to at least 2030 before we can even start talking about a supply demand balance. Like I think it's probably going to be longer than that. But again, like as we see new technologies come out, then that might change faster. Even if it changes faster and even if new technologies come out, I still don't see a scenario in which a data center that goes live today will be ripped offline 5 years from now. I don't think it's going to happen. Maybe you could argue like 7 years from now, it would be replaced. But for context, there are chips in Google data centers which are more than 7 years old and they're still sitting there. And they're not being pulled out. The evidence points towards like there being some additional use case well beyond the 3 years that people might think. In terms of what it means for us, two things. One is like we're there to help clients understand an at least value, right, for those assets over a given period of time. But the second thing is, in order for our clients to feel any kind of concern or for us to pay claims, the borrower has to default, and the borrower has to default because they don't have paying clients anymore, right? So even if the depreciation is faster than we
Is there any particular point of view that you currently have in the AI market that it's a
I
little
guess
bit
the one thing
contrarian?
I would point to is, I don't know if it's contrarian, and I shouldn't bite the hand that feeds you, right? NVIDIA has been a fantastic partner. They've introduced us to so many different people, which we hugely appreciate. And it's not anything against them. It's more like, where do I think the growth is going to continue? I think what is probably going to happen is, at least from what I can see, I think NVIDIA is going to end up being primarily an enterprise solution. And then if I had to put my money somewhere, I would say I think Apple is going to come out with, and arguably already has, come out with some piece of hardware or pieces of hardware that address more consumer and small business solutions. And we've seen the early days of that with the Mac Mini, which have been hugely popular as mini servers. Like if you stack up a bunch of Mac Minis, then you can create your own mini server and run models on them. I would be highly surprised if Apple didn't lean into that.
That's such a good one. What do you think, just briefly, about like the whole changes in management currently? Do you think it's partly because of like that change and going deep into people running locally
You mean at
their own
Apple?
stuff?
Bringing
Yeah.
the hardware guy in as the new
Yeah.
CEO.
I mean, I think Cook he only had a few years left anyway. He's done a phenomenal job. He's grown that company like bananas. But he was never a hardware guy, and he knows he's not a hardware guy, and he has multiple hardware failures like in his resume, despite the fact that they grew significantly. So if I had to guess, if I had to try and put myself in Tim's head, my assumption would be they started off with kind of a genius CEO who understood what people want, right? He understood emotional purchases. He understood how to tell people what they want, not to figure out what they want, but how to tell them what they want. So I wouldn't characterize Steve Jobs as a hardware person. I would characterize him more as a market maker, which I think is different. And so Steve Jobs kind of made the market, and then Tim Cook grew that market. And now I think Tim Cook understands that in order for it to continue to grow, they need a successful future hardware plan that he doesn't have. And again, totally like my opinion on this. Now I sound like this old valuation buff. I wouldn't be surprised if in the next 18 months, like they make a big announcement about some form of at-home unit that you can run advanced models on, and they go after that small to medium-sized enterprise and consumer business.
Well, if that happens, you heard it here first. If it doesn't happen, no one's going to remember, because nobody remembers when people are wrong, much like Michael Burry, but they do remember
Yes.
when he was
If
right.
you say things often enough, then one of them is going to come true.
Yeah. What do you think the hardware piece is going to come up between?
I think OpenAI's hardware is going to be a massive flop. I think it's going to be the same as what happened with Meta, same thing that happened with Amazon. I don't think anyone's going to buy it. Partly because I think OpenAI has put itself into a position where it's been vilified. People don't want, like, whether it's a pendant, whether it's a phone, whatever it is, people don't want to be associated with it. They don't want it around them. There's still... Apple has the right approach here. Like, people value their privacy as much as Apple may or may not like be the right answer. Their general marketing position is correct. I think OpenAI's lost that race. So I would gladly, like, I shouldn't say gladly, I will predict that they won't succeed with that.
Interesting. I don't know if maybe this is fake news, but I recently saw something where like Apple is doing like the AirPods are going to have some kind of camera.
Yeah, they're going to have a camera in them, but it doesn't
Okay.
have it's not like a picture camera. It's a depth and motion sense. So you can do gestural features in the air, and it will recognize the gestural features in the air, but you can't take pictures with.
So talk to me about one thing. How in the world did you get one of the most coveted insurance companies?
It took a while.
And like one of the most conservative ones.
Yeah, it took a while.
They're German, after all.
It was most success, right? And you guys know this. Like, it's a combination of skill and luck and timing. And we worked hard on all of those. So when we first launched, we had pretty rudimentary technology, like a contract that wasn't great. And we managed to convince a small insurance company out of Lloyd's to back us. And they were super enthusiastic and helpful, but we just, I mean, it wasn't right for them and it wasn't right for us. But what it did do for us was demonstrate to the broader insurance market that there was interest in what we were doing. And so we leveraged that into a bigger contract with AXA. And so the contract with AXA was a little bit better than the previous one. The insurance was better because it was with AXA. And so we started having conversations with different banks and different lenders, and we started to do business. And what I found from the business that we did and from talking to the banks was that our contract still wasn't good enough. And this is normal. Like, you go through product evolution, right? Like you need to make sure that you're listening to the clients, you're evolving your product to make sure that it meets their needs. So we started conversations with Munich Re. Actually, I take that back. The first thing I did was to mention to AXA, I was like, look, this isn't quite right. Can we make some of these changes? And they said, maybe, why don't you work on the contract and then we'll take a look. I didn't like the maybe, so I started talking to Munich Re. And I was like, guys, like, we currently have AXA, like, don't you want to replace them, kind of thing? And then you just play them off each other. And they did want to replace them. So they ended up offering us a much better contract than we had with AXA. And then we closed that about 2 years ago with Munich Re. And then the timing thing was great because they had just launched a new division called Munich Re AI Shore, which is basically specifically focused on AI companies. So they were super excited about what we're doing, the fact that we built our own AI, and we gave them a whole bunch of back testing, like all of those things. From beginning to end, it probably took about 6 to 9 months of negotiations and getting them comfortable. And then we launched, and they've been fantastic partners, like super to work with, really supportive, and want to sort of continue working with us. So we've been lucky.
That's beautiful. One more question. You mentioned something about Gen Zero and Apollo and day-to-day marketing. Before I ask you that question, how does it currently work for you guys? Do you price it one time, and does that insurance work for 12 months? Like, how does that work?
So at the moment, we price an asset in the cadence that the client needs, right? If a client wants it, and it depends on the asset. With something like a luxury asset, then it's very illiquid. So usually we price it once per annum or something in that range. Whereas something like a GPU or a private jet, it's a little bit more liquid, but B, also depreciates. So we assign a price for every month of the term of the loan. So in the event there's a default in a given month, then they know which price we predicted and which price we're backing up. Whereas that isn't the case with other assets that either hold steady or appreciate or don't need that cadence. But the reason why I say we also do it how they want is because the client can ask us to give them a monthly update. We're happy to give them monthly mark to markets. And actually, that's something that we're rolling out as a not just a feature, but like a standard operating procedure. Is as loans enter the last 6 months of the term, even if we've given a valuation over the course of that 6 months, then we're going to start offering the client like real-time monthly valuations on that asset so that they can get more comfortable with understanding where has the market actually moved.
And so if Apollo, let's say they're the first ones, they're trying to move to daily marks. When do you think that Apollo will have daily marks?
And it's a tough one. I don't know enough about the intangible assets space. I know like the 73 Strings, we've been in touch multiple times, met their CEO. They do a lot in that space. I actually think it's a lot harder to price intangibles, but that's just me because I know my space more. I would imagine that they can probably do it, like, I don't know, I'm sure they put a lot of money behind it, get a technology team internally behind it and do it within the next 6 months, maybe. I think the bigger concern is how accurate are those daily valuations, right? How accurate are those marks? Because historically speaking, I mean, if you could put Apollo to the side for a moment because they seem or claim to be more accurate or have better marks. Historically speaking, marks within the sector are very difficult. It's part of the reason why we have the problem we have right now. First Brands wasn't a mark problem, it was a fraud problem, but there are other problems out there where the issue was marks. And I don't know if daily marking is necessarily going to solve it if you don't solve the underlying methodology for how you determine the valuation in the first place. That's, in my mind, the biggest.
Talk to me about that, because I know we've talked about specifically about methodology valuation on these funds. Explain a little bit more of that. Like, how does it currently happen, and what would need to change in order to get accurate underlying pricing?
Well, I mean, I think this is one of the fundamental problems with pricing some of these risks, right? Let's say you're lending to a business, which is often the case. You're not really looking at any of the assets. You're looking at the business, you're looking at revenue, and you're looking at that business's capability or ability to be able to meet those revenue targets. I think that is part of the challenge. Like, how deep do you go on that business's client's ability to pay their receivables, right? How deep do you go into the risk associated with that business's revenue and their costs and whatever other risks they may be subject to, right? Like, maybe it's a bad example, but if you have a small, let's say you have a small chip maker, right? And you might think that in today's environment, wow, this is fantastic. Like, I'm willing to lend that chip maker whatever I want or whatever they want because everybody wants chips. But nobody had like restricted helium supply on their bingo card for 2026. And if you're a lender and you hopefully did have restricted helium supply on your bingo card for 2026. But that's the level that you have to go to as a lender operating in this space, where that's why I get concerned about the accuracy of valuations in non-tangible assets, because the number of variables that you have to account for, right, in order to be able to recognize that, and in this case that we're talking about, the revenue, that business's ability to sell assets, right, in this case is not a function of their ability to sell. It's a function of their ability, their supply, right? Like, which they had no way of knowing, no way of being able to account for. And maybe there's some insurance product that kicks in to be able to make up the difference. But I think that's where it is as much art as it is science. And I know a lot of these companies far better than me and far better placed to be able to answer the question and understand the value drivers, but they're also like, that black hole just scares me. Like, I don't know enough like to be able to price that thing, but this asset, like, I know that it's sold over here, like one just like it sold yesterday for X amount. Like, I'm happy to take
One
that
of the
bet.
things that it's often talked about is tokenization, and especially on like where you sit, you don't want to hear about that word, or less about tokenization, but blockchain in itself. Where do you think the biggest use cases are applied now? And where do you think the biggest use cases will be applied that it actually benefits a lot of it or solves for a lot of the issues that we have today? And where does it not fix the issues that we have today and perhaps shouldn't be focused on that? Maybe, and we can maybe take it to the perspective of barkr. How does it work for you?
When we first started building the tech stack, right? Like, one of the things that we discussed was, does it make sense to issue our contracts as smart contracts, right? Like, does that make sense for us as a business? And we were new and small and trying to be lean and efficient. And the reality is that, like, it's nice, but it's not required. Like, we could conduct the business just fine without it. And if anything, adding it in to the tech stack made it more complicated and annoying. It doesn't mean that we might not do it eventually, and there might be good reason to do it eventually. But my general rule of thumb is, like, if it's not additive, if it's not making something more efficient, if it's not helping you, if it's not increasing your revenue, like, if it's just a nice to have, then, like, delete it. And it's one of the few things that I agree with Elon about, which is that, like, aside from the fact that the man clearly is like a machine to be able to build all those companies, the way he approaches things like optimization and efficiency, and it just kind of makes sense, right? Like, if there's something sitting there that you don't need, that your business can function fine without it, then that means that you don't need it. Like, that means you should just delete it, and then the whole thing becomes far more efficient. So I think in terms of tokenization, in terms of how I think about smart contracts and things like that from barkr's perspective, it hasn't really been something that has materially been seen to change or improve our business. So we haven't needed or wanted to do it yet. That might change. Maybe as we automate more things, maybe there's an argument for us to serve clients in smart contracts. In terms of lending, I think there is potentially an application, and we've spoken to some lenders who are specifically doing this. If you are effectively crowdsourcing the loan, right? Like if you're in a position where either that's your business model or the loan is so big that you have to syndicate it somehow, then a smart contract or some kind of tokenization could be an elegant solution. Again, unfortunately, the challenge I have right now is that these deals are happening without smart contracts and tokenization. Like they're still happening. I don't know if until such a time as it becomes easier to provide some additional benefit beyond the existing infrastructure, I don't see it taking over the lending world.
Can you tell me what is like a fact or something that surprised you after not sure if it's training or fine tuning your model, but like something that surprised you, like through that process of training models?
I would say there's probably two things. One is was actually working, right? We wanted to make sure that if we asked Claude or ChatGPT to price something and we gave it similar data points as to what we had, that we were still coming out ahead. And to start off with, we actually found that we weren't. We actually found that they were performing better than we were, and we tried to start sort of digging into why. And that's also like part of the reason why we did a big push about making sure that clients were sharing private data with us, right? Because it supports the private data set that we have access to that OpenAI and Anthropic do not have access to. But then I was really quite surprised because I thought, well, we've specifically trained a model. Like, it's supposed to be better. This is the one thing that it's supposed to do. Why is it not better? And then what we've realized was that this is around the time that we switched over from Llama 3.2 to the Gemma model. We realized that if we had greater control over the way the data was structured from the outset, or if we paid more attention to it rather than keeping it as just like a reference database, but actually start to better structure the database, then that started to have a material impact on the output. So we did. And now I have a mandate with the team. I'm like, I want the model to improve by 50% every 3 months. And that's what's been happening, which is great. So now when you punch it into GPT or Claude or whatever, it'll spit you out a number or a range, but we are now significantly more accurate than we were at the beginning.
Thomas, this has been an incredible conversation. I could ask you 10,000 more things. I love talking to you.
Do it
I
again.
love what you're doing. I'm ready. When a news happens, I'm calling you and we say, okay, let's do it. Let's run a call. Let's talk about it. So I think I had a pen from Anthropic that once said make the simple thing that works, or make it simple, and I think that's how I would describe what you're doing, because it's so simple and it's so innovative at the same time.
Thank you.
I just love what you're doing.
We try and present it that way. I want our clients to think of it as simply as possible, despite the fact that it's quite complex to do.
Hopefully we'll have you again in a very short period of time to talk more, whether it's about GPUs or data structures or data centers, or whether microburr is right or not.